Hey, good morning. I'm saying good morning because it's morning while we're recording this. Hey, my longtime video recorder, Scott Bates, has been down with some back and sciatic issues, and so prayers are going out to him. So he has not been able to help us out, and hoping for a speedy recovery for him. But as we get started today, we've had a number of questions, and perhaps some of you have had them and haven't even voiced them yet, where people have been dealing with this issue of that goes like this. Hey, the market's up and I'm not. What's going on here? And strangely, it's being stated as a statement of fact as opposed to a question as to why. And so I wanted to explore that a little bit today. I'm just going to use, there's a really good letter put out by Matson Money in the client reports for this year. And I'm just going to paraphrase some of it because it really speaks to this issue quite well. This feeling that people are having is due almost entirely to the fact that the S&P 500 last year was both flirting with and periodically achieving new highs. Now, the S&P 500 and the Dow Jones are leading indicators of what the U.S. large company stocks are doing, the equities there, but it does not represent the entire stock market. The market includes both domestic, that's U.S., and international equities. It also consists of the following asset classes: large cap, small cap, micro cap, value, growth, as well as emerging markets, emerging small, and emerging small value stocks. Additionally, many people use fixed income to moderate risk and volatility that is also spliced into many portfolios. So our recommended portfolios are typically invested across many asset classes, and they're engineered to not be dependent upon any one of those asset classes. They are, in fact, globally diversified. So diversification of asset class aims to manage risk, and what our goal is that for the investor, we are not going to be ever experiencing, we hope, experience the lowest return of the asset classes, but we're also not likely to hit home runs and grab the highest return of the highest performing asset classes. We believe that a reasonable expectation is a return commensurate with that of several asset classes with which we invest. And for those that have plans drawn, it is designed to capture the return we need to capture the goal of the plan, of which we've been very, very good at doing. Generally, we feel the strategy is rather unassuming and quite palatable, unless, of course, the highest performing asset class is comprised of the S&P 500 or the Dow, both of which are remarkably in investors' faces every single day, both by the media and sometimes by friends at work and at parties. And this is the battle that discipline and prudence faces. So the statement of fact about the market is actually flawed because the market is comprised of all those different areas, and the market last year, as we define it, was in fact not up like people's perception. It's worth remembering that there's always going to be an asset class that's outperforming all the rest. When it's the S&P or the Dow, due to that media spotlight, it really grabs people's notice. We've also seen that this can make up a disproportionate percentage allocation of many undiversified portfolios. So discipline's not for the weak. Success is its long-term reward for the maintenance of it. But I just want to remind that focus and action resulting from the current moment or the current year may be at the expense of your next 20 years. So we must always keep that in mind. I also have to mention in all these that past performance is no guarantee for future results. In the end, choosing a wise financial strategy and sticking to it can have a tremendous impact on your long-term financial health. Chasing performance through buying and selling is a risky game, and historically speaking, it may reduce an investor's return. So, as always, thanks for tuning in. Please feel free to touch base either by email or call if you have questions. Until next time, thank you.